Welcome to another episode of The Riffle, a podcast series brought to you by 10 Leaves.
Yeah, we're really excited to get into this one.
We are, because, usually when we think about building like a massive gleaming skyscraper, there's this expectation of just rigorous, uncompromising structure.
Right, absolutely.
Like you don't just start pouring concrete and, hope it stays up.
No, you'd have a disaster on your hands.
Exactly. You need a blueprint, you need to calculate the structural load limits, and you need a whole army of inspectors checking like every single rivet before you add the next floor.
Which makes perfect sense when, life and limb are on the line. I mean, the architecture has to be highly categorized, highly visible, and built to this universal standard.
Right.
Because otherwise, the whole thing just comes down with the slightest gust of wind.
Yeah, but then, and this is what's crazy, you step into the world of corporate structuring and financial accounting, and suddenly a surprising number of founders treat it like they're just, building a treehouse in their backyard.
Yeah, they really do. It's wild.
They just think, oh, I'll figure out where the walls go later. Let's just get the business running.
And that's exactly how things collapse.
Right. So today we are doing a deep dive into a hefty stack of documents from the Abu Dhabi Global Market, the ADGM. Specifically, we're looking at the Registration Authority.
Yeah, there's a lot of material here.
There is. We are going to unpack their really comprehensive annual accounts guidance from September 2022, and then kind of peer over the horizon at their brand new enhanced information requirements, which are slated for July 2026.
And, this is a critical stack of documents for anyone touching the corporate world right now, especially in a rapidly growing hub like Abu Dhabi.
Oh, for sure.
Because navigating these corporate accounting rules, it's far more than just some administrative chore to avoid a late fee.
Yeah, it's not just a parking ticket.
Exactly.
Yeah.
Understanding this framework dictates how a business is fundamentally structured, how the financial data is tracked, and ultimately how a company is perceived on the global stage.
So if you are an entrepreneur setting up shop, or maybe you're a compliance officer, or honestly just someone who is insanely curious about how the engines of these global financial hubs actually function under the hood, you should care about this.
Definitely.
Because the rules aren't arbitrary. There is this deep mechanical logic to them.
Yeah, and to set the broader context here, the ADGM operates on International Accounting Standards, or IAS, which...
Right, global standard.
Exactly, maintained by the International Accounting Standards Board.
Yeah.
So when a company follows the ADGM's local rules for submitting accounts, they are actively tying their business into the global financial ecosystem.
They're speaking the same language.
Yeah. They're adopting the exact same financial language used by multinational conglomerates in London or Frankfurt or Tokyo.
Okay, let's unpack this blueprint. Because before a company can even figure out what financial data they need to file, they have to establish when their financial timeline actually starts and ends.
Which trips a lot of people up.
Yeah. Reading through the guidance, everything hinges on this concept called the accounting reference date, or the ARD.
Right, the ARD.
And setting your ARD is basically like choosing your company's fiscal orbit around the sun.
I like that analogy.
Thanks. I mean, exactly when you finish that orbit determines when the whole regulatory clock starts ticking.
It does. The entire financial year
Yeah.
is anchored by that specific ARD. So when you incorporate in the ADGM, you have to select this date.
Okay.
If you choose, say, December 31st, then every year your financial orbit concludes on December 31st.
Makes sense.
And here's the catchment. The guidance is remarkably strict about how you initiate that very first orbit.
Right, because you can't just pick anything.
Exactly. Your initial financial period has to fall within a specific window of 6 to 18 months.
Okay, wait, let me make sure I'm mapping this out right. So if I incorporate a brand new startup on November 1st, and I decide I really want my ARD to be December 31st just to, match the standard calendar year.
Right.
I can't just run a quick 2-month financial year for November and December and just call it my first orbit.
You cannot. Absolutely not.
Oh, wow, okay.
Because a 2-month accounting period, it just doesn't provide enough data for a meaningful financial snapshot.
Oh, I see.
Yeah, because it falls short of that 6-month minimum. You are forced to ride that first financial year all the way out to December 31st of the following year.
Oh, man. So that creates, what, a 14-month initial orbit?
Exactly. It forces a company to establish a substantive block of operational history before they even submit their first official IAS-compliant accounts.
And during that time, and, well, every subsequent year too. The rules state every single ADGM company must keep adequate accounting records for a minimum of 10 years.
10 years, yes.
Which, honestly, that feels like an eternity in startup years.
It really does.
And the guidance specifically says they must be kept at the registered office and be sufficient to show the financial position of the company at any time with reasonable accuracy.
You're right. That phrasing is key.
So what does reasonable accuracy at any time actually mean in practice, like for a normal founder?
Well, it basically means the classic shoebox full of receipts that you just hand to an accountant once a year approach.
Right, the classic move.
Yeah, that is fundamentally illegal here.
Wow, okay.
A regulatory body or an auditor should be able to walk into your registered office on like a random Tuesday in March and demand to see your current liabilities and assets.
Just on the spot.
Exactly. The internal bookkeeping has to be continuous.
That is intense.
It is. But the 10-year requirement exists because financial fraud investigations or complex tax audits or massive civil litigations, they often require looking back a whole decade to find exactly where a systemic issue began.
So the records literally have to outlive the immediate memory of the founders.
Exactly. They have to tell the whole story.
That makes the stakes very real. But let's go back to the mechanics of that fiscal orbit for a second, because there's this fascinating asymmetry in the rules.
Oh, regarding changing the ARD.
Yeah. The ADGM says you can change your ARD to shorten your accounting period basically as often as you like.
Right.
Like, you can speed up your year and close the books early whenever it suits you. But if you want to extend your accounting period, slow your orbit down, you can only do that once every 5 years and never beyond 18 months total.
That's correct.
Why? Like, why make it so easy to speed up but so insanely difficult to slow down?
What's fascinating here is that it really comes down to the underlying psychology of financial reporting and, honestly, market manipulation.
Oh, really?
Yeah. Restricting those extensions prevents companies from endlessly kicking the can down the road.
Mm.
Just imagine a scenario where a company has an absolutely disastrous third quarter.
Okay.
Like they lose a major client, or maybe a massive investment just goes to zero overnight.
So the immediate instinct would be to hide it.
And naturally, yeah. If they could endlessly extend their financial year, they could just push their ARD back 6 months.
Yeah.
And then maybe another 6 months, just hoping a spectacular future quarter will eventually wash out the terrible one before the public accounts ever have to be filed.
Ah, that makes so much sense. By capping extensions to once every 5 years, the ADGM is just forcing transparency.
Precisely. You might be able to close the books early to, say, align with the new parent company's calendar.
Sure.
But you cannot legally delay the bad news.
You can't just manipulate time to cover your tracks. I love that.
No time travel allowed.
So once that timeline is locked in and the orbit is set, the ADGM scales the actual weight of the reporting burden based on the size of the entity.
Right, the tiered system.
Yeah, they've constructed this whole tiered system. Let's look at the lightest weight class first, micro-entities.
So a micro-entity is strictly defined in the guidance. It means you have a turnover of no more than 2.5 million US dollars and a maximum of 9 employees.
Okay, pretty small.
Very small. And companies that fit comfortably inside that box, they receive a significantly lighter regulatory burden. They are permitted to file highly simplified accounts.
Right.
And most importantly, they can skip the really expensive process of a formal third-party audit.
Which is a huge relief for a tiny startup. But there is a very specific, almost theatrical hoop they make you jump through to actually claim that audit exemption.
Yes. The disclaimer.
Yeah. The company has to print a statutory disclaimer statement right on the balance sheet, prominently placed directly above the director's printed name and signature.
Yes.
Declaring that the accounts were prepared in accordance with the microentity provisions. Why does the literal placement on the page matter so much?
Because placing it immediately above the signature is a deliberate legal trapdoor.
A trapdoor?
Yeah, for directors who might try to feign ignorance later on.
Oh.
See, in contract law, there is this old defense where someone might claim, oh, I didn't read the fine print at the very bottom of the page.
Right, the classic excuse.
Exactly. So by forcing the text to be immediately above the physical signature, the director is personally acknowledging that they actively chose to bypass an independent auditor based on their size.
So if it turns out they actually had, 15 employees and were secretly hiding revenue?
The director cannot blame the accountant.
Because they signed their name directly beneath the statement of exemption?
Exactly. You signed it, you own it.
Man, that is smart. Okay, so then we move up the ladder to small companies. The cap here is a turnover up to 13.5 million USD with a maximum of 35 employees.
Right.
And they also qualify for an audit exemption provided they include a similar statutory statement, right?
Yes, they get the same kind of break.
But when we hit medium-sized companies, so that's turnover up to 68 million USD, maximum 75 employees, the training wheels just completely come off.
Oh, completely.
Yeah.
The regulatory environment changes drastically at the medium tier.
Yeah.
A medium-sized company must deliver the full compliance package to the Registration Authority.
And what's in the full package?
Well, it includes a really detailed balance sheet, a formal director's report outlining the state of the business, and crucially, a comprehensive auditor's report from an ADGM registered auditor.
Okay, so what does this all mean in practice? Like, if I'm a small crypto trading firm operating in the ADGM and I only have 3 employees and maybe, I don't know, $1 million in turnover,
Okay.
I easily fit the micro entity definition. Can I just slap that disclaimer on my balance sheet and skip the auditors to save 50 grand a year?
Not a chance.
Wait, really? Why not?
Because the ADGM includes a vital caveat that completely supersedes the size requirements.
Oh, interesting.
Yeah. Public interest entities and financial institutions are entirely ineligible for these micro and small audit exemptions.
So even with 3 employees?
Doesn't matter. Your crypto trading firm might be tiny in terms of headcount, but its function places it in a completely different regulatory universe.
Because it's not about the size of the company, it's about the blast radius if things go wrong.
Precisely the point. Financial institutions handle systemic risk.
Right.
They hold client assets, they facilitate trades, they interconnect with other financial pipelines.
They can bring other people down with them.
Exactly. The ADGM will happily give a regulatory break to, say, a boutique graphic design agency or a 3-person consulting firm to help them thrive.
Sure.
Because if they go bankrupt, the damage is localized. But if an entity is moving other people's money, the systemic risk demands an independent audit, regardless of whether you have 2 employees or 2,000.
Okay, that makes perfect sense. There is a small exception for fintech participants I saw, but standard financial institutions are fully locked in.
Yes, absolutely.
So if you're a standard business, this tier system makes perfect sense. But, founders and corporate lawyers are highly creative people.
We are very creative, yes.
What's stopping a massive conglomerate from just artificially splitting itself into 50 tiny micro entities to just completely hide their overall financial health and avoid audits across the board?
Well, that is exactly where the concept of consolidated accounts and edge cases come into play.
Okay.
Because regulatory frameworks are truly tested by complex corporate structures.
Yeah.
Not your standard neighborhood coffee shop.
Right.
To address your conglomerate scenario, the ADGM looks at the group as a whole. In fact, let's look at dormant subsidiaries, which is a really common feature of large groups.
Okay, yeah.
Generally, every single limited company must prepare and file its own accounts. But if a company is a qualifying dormant subsidiary, meaning no significant accounting transactions occurred during the year, they are exempt from filing their own accounts.
But only if they submit a very specific 3-part package.
Right.
I found this package so fascinating because it really shows how the legal liability shifts.
It does.
The dormant subsidiary has to provide a written notice of agreement by its members, a formal statement of guarantee from the parent company, and a copy of the parent company's consolidated group accounts.
Yeah. The parent company is essentially stepping into the legal shoes of the dormant entity.
Just taking it all on.
Exactly. By issuing that statement of guarantee, the parent is telling the ADGM, look, we take full statutory responsibility for any hidden liabilities this sleeping entity might have, and here are our massive audited group accounts to prove we actually have the capital to back them up.
Yeah, that is brilliant. It eliminates duplicate paperwork for the subsidiary, but it doesn't sacrifice an ounce of accountability.
Exactly.
Then you have these restricted scope companies, or RSCs.
Yes, the RSC.
These are private, limited companies that benefit from significantly reduced disclosure requirements, right? Usually used by family offices to manage wealth privately.
Correct.
And as long as an RSC doesn't publish its accounts to the public, they are completely exempt from filing them centrally with the registration authority. Like, they still have to keep the 10-year records.
Right, internally.
But they don't have to upload them.
That's right. The catch, however, is what happens if an RSC decides to step out of the shadows.
Oh.
If they restructure and re-register as a standard non-RSC private company, the guidance explicitly states their financial year immediately resets.
Right on the exact date the new certificate of incorporation is issued.
Exactly.
Their old life as a private RSC ends the day prior, and a brand new financial timeline just starts on day one. They can no longer hide their accounts from the public registry.
Exactly. The veil is lifted.
Wait, hold on. I'm completely lost on how this compares to a company migration.
Migrations are tricky.
Yeah, let's say a company decides to physically migrate its jurisdiction. Say they are continuing into the ADGM from, like, the British Virgin Islands.
Okay, common scenario.
If I move from the BVI to the ADGM in July, how do I not start a new financial year? Am I filing BVI taxes in Abu Dhabi? Like, how does that work?
It is a notoriously complex process.
Yeah.
But the short answer is that the financial timeline does not break.
It doesn't break at all.
No. Think of it less like starting a new company and more like a company changing its legal citizenship midway through its life.
Oh, interesting.
The ADGM guidance explicitly states the financial year continues uninterrupted. So if a company with a standard calendar year end migrates on July 1st, they do not file a 6-month return in the BVI and a 6-month return in the ADGM.
They don't.
No, they prepare one single set of IES-compliant accounts covering the entire 12 months.
So the auditor basically has to smash 6 months of BVI operational law and 6 months of ADGM regulatory law into one final document.
Yes, and it is a logistical nightmare for the audit teams.
I can imagine.
They're required to audit a single financial year containing transactions spanning 2 entirely different legal and tax jurisdictions.
That sounds awful.
It's intense. They have to reconcile any tax liabilities owed to the BVI government before the exit. They have to map the assets as they transition into the UAE framework and ensure the final presentation meets international accounting standards.
Wow.
It requires meticulous, extensive disclosure notes explaining the exact timeline of the migration and how all the assets were valued across the border.
So it's literally like moving into a new house halfway through the year, but keeping the exact same calendar on the wall.
That's exactly it.
You don't restart January just because you changed your address, but you definitely have to explain to the IRS why your utility bills suddenly changed currencies in July.
Yes, a very long explanation in the notes.
And just to throw one more wrench into the gears, the guidance details how to handle cell companies.
Oh, yes.
Protected cell companies and incorporated cell companies. These are highly specialized entities with a central core and legally distinct separated cells, often used in insurance or complex wealth management to isolate risk.
Right. And the fundamental rule for cell companies is segregation.
Okay.
They must prepare separate accounts for each individual cell, fairly presenting each cell's unique assets, liabilities, and profits.
So they don't bleed into each other.
Exactly. If cell A goes bankrupt, it cannot legally drag down the assets in cell B.
But the guidance notes that while the core company files its accounts, the individual cell accounts are not required to be filed centrally with the registration authority.
Correct.
Why the lack of transparency there? Like, why hide the cells?
It is actually about the nature of the investors. Cell companies are generally restricted to sophisticated professional clients.
Oh, okay.
The central EDGM registry needs to see the health of the core entity, right, to ensure the overarching structure is sound.
Makes sense.
The individual cells, however, are essentially ring-fenced microenvironments. The accounts must exist, and they must be accurate for the specific investors of that specific cell, but broadcasting them to the public registry just doesn't serve a systemic regulatory purpose.
Okay, so if you're sitting there mapping this all out, we've got all these varying tiers based on size.
Right.
Carve-outs for financial institutions, parent guarantees for dormant subsidiaries, migrating calendars from the Caribbean, and ring-fence cells that don't even file centrally.
That's a lot to keep track of.
Processing this volume of varied information must be an absolute administrative bottleneck for the ADGM, which I guess brings us to the incoming overhaul.
Yes. The July 2026 Enhanced Information Requirements.
Here's where it gets really interesting, but also where I honestly start getting a little skeptical.
Oh, why is that?
Because up until now, a lot of this filing has just been submitting digital documents. But as of July 2026, when companies use the ORS, the Online Registry Solution Portal, they won't just be attaching a PDF of their accounts anymore.
No, they won't.
They are going to be forced to submit new, highly structured data fields. Like, they are demanding granular details inputted directly into the system's drop-down menus and forced numerical fields.
Yes, and the shift from free text PDFs to structured field is monumental.
It's huge. huge.
They're requiring the specific name of the audit firm, the name of the individual principal signing the audit report,
Wow.
the exact type of audit opinion issued, whether it's clean or qualified. They want the exact audit fee for the standalone entity and the group audit fee if applicable.
That's getting so specific.
Exact revenue numbers,
Huh.
exact employee counts, and a mandatory confirmation of whether the accounts are in U.S. dollars.
Okay, I have to push back on this.
Go ahead.
They aren't changing the actual filing deadlines, right?
Right.
They aren't altering the fundamental international accounting standards.
Yeah.
They are just forcing founders and accountants to fill out a dozen more bureaucratic data fields before they can even hit submit on the portal. Are they just trying to create more red tape to justify the registration authority's existence?
If we connect this to the bigger picture, while it might feel like red tape to the person doing the data entry, the primary driver here is the complete death of the static PDF.
The death of the PDF.
Yes, a PDF is essentially a photograph of text. It is a dead end for data analysis.
Oh, I see what you're saying.
Prior to this, if the ADGM wanted to understand, say, the average audit fee for medium-sized tech startups, a team of analysts would have to manually open hundreds of individual PDF files, scroll all the way down to the notes section, find the fee, and manually type it into a master spreadsheet.
Yeah, that's completely unscalable.
It is impossible to monitor a modern economy that way. By forcing structured data, where a number must be typed into a specific coded box, the ADGM can run advanced macro analytics on the entire financial hub instantly.
Wow. Instantly.
Instantly. They can query the database and say, show me every single micro entity that has reported exactly 9 employees and $2.49 million in revenue for 3 consecutive years.
Oh, man. Because that highly specific pattern suggests the company is artificially capping its reported growth to illegally avoid the audit threshold.
Exactly.
Oh, wow. So they can spot the anomalies instantly.
Yes. Or they could run a query saying, show me all the companies using an auditor who is charging 80% below the average market rate.
Let me guess, because an auditor charging that little might just be rubber stamping the accounts without actually looking at the underlying ledgers.
Precisely. Structured data turns the ADGM from a passive library of documents into an active analytical watchdog.
That is incredibly powerful. But the guidance is also very quick to point out that even in this new 2026 matrix, this is still a submission-based process, meaning acceptance of the filing on the ORS portal, even if all the structured data fields turn green, that does not mean the ADGM has legally blessed it or certified it as compliant.
No. Submission is never certification. The portal is simply collecting the data. The legal liability remains entirely on the shoulders of the entity and its directors.
Right.
If you hit submit and the system accepts it, you are not absolved of liability if it is later discovered you lied about your revenue or manipulated the structured data.
Right. The green check mark doesn't mean you're innocent.
Exactly.
So speaking of hitting submit, let's get into the actual mechanics of crossing the finish line and what happens when things go wrong.
Okay, let's go.
A company can know their timeline, their tier, all their exemptions, and have all this new 2026 data prepared. But what are the hard deadlines?
So for a standard financial year, private companies have 9 months after their accounting reference date to file.
Okay, 9 months.
And public companies have a tighter window of just 6 months.
And for your very first accounts, the math gets a little tricky. It's 9 or 6 months from the first anniversary of your incorporation, factoring in that 6 to 18-month rule we discussed earlier.
Right, the 14-month orbit example.
Yeah. And honestly, calculating that first deadline can induce a migraine. But the ADGM actually provides a downloadable Excel calculator on their website specifically to help founders figure out their exact first filing date.
Which is a very pragmatic tool, honestly.
Super helpful.
And the actual process of filing is 100% digital via the ORS portal. You log in, you click Maintain Company, select Lodge Annual Accounts, fill out the new structured fields, upload your supporting documents, and submit.
No paper at all.
None. The Registration Authority does not accept paper filings under any circumstances.
Okay, so let's run a hypothetical. You're a stress founder. It's 11 p.m. on the night before your 9-month deadline.
A classic scenario.
Right. You rush through the ORS portal and hit submit. But you wake up the next morning, look at your downloaded copy, and realize you accidentally misreported a non-material figure in the structured data.
Oh, no.
Like maybe a typo in a minor expense column.
Yeah.
Are you doomed to pay massive penalties, or is there a grace mechanism to fix a mistake once it's in the system?
You are not doomed, provided you act transparently.
Okay, yeah.
How you fix an error depends entirely on its severity. If it is a massive material error, say, you overstated revenue by 50% and it completely misrepresents your financial position.
That's a big one.
Yes. In that case, you are required to execute a prior period adjustment.
And what is that?
This is a complex accounting mechanism that involves restating past figures and jumping through significant regulatory hoops to alert stakeholders that the previous data was fundamentally flawed.
Yikes. Okay. But for the non-material typo, like the little expense column mistake.
For a non-material error, it is much simpler. You generally fix it as an adjustment in your current year's ongoing figures.
Oh, that's easy.
Yeah. Furthermore, if you just need to swap out one specific minor part of the accounts that were already submitted, the ADGM allows you to file a signed note explaining exactly what has been changed.
So you don't just sneak a new PDF in there.
No, absolutely not. You don't try to sneak a new version of the PDF into the system to overwrite the old one. You openly declare the correction, and that explanatory note is filed directly alongside the original accounts in the ORS portal.
That makes total sense. It preserves the integrity of the audit trail.
Exactly.
Well, we have covered some serious structural ground today.
We really have.
We started by figuring out how to set your company's fiscal orbit with the accounting reference date and why you can't just slow time down to hide a bad quarter.
Right.
We learned how to find your regulatory weight class, whether you are a microentity utilizing strategic disclaimer placements or a financial institution that requires a full audit regardless of size.
Essential stuff.
We explored the complex edge cases, like how migrating from the BVI forces an auditor to reconcile two global legal systems into one document. And finally, we looked over the horizon at the July 2026 landscape, where the ADGM is turning flat, unreadable PDFs into this dynamic matrix of structured data.
And this raises an important question regarding where this is all heading.
Oh.
Yeah. As the ADGM shifts to collecting these highly structured, granular data points, audit fees, specific revenue markers, exact employee counts, we are essentially watching the foundation being laid for AI-driven regulatory oversight.
Oh, wow. It's like having an automated stress sensor built right into the steel beams of that skyscraper we talked about at the beginning.
That is exactly the right analogy. Think about the velocity of that structured data. In the very near future, it won't just be human analysts running queries for anomalies.
Right, because there's just too much data.
Exactly. Could a machine learning algorithm trained by the ADGM instantly flag a company for financial distress or spot a systemic compliance risk the very moment that stressed founder hits submit on the ORS portal?
Before anyone even reads it.
Right. We might be entering an era where the regulator systems can diagnose a fatal structural flaw in a company's architecture before the company's own board of directors even realizes there's a problem.
It pings the inspector the second the weight shifts, long before the first crack even appears in the drywall.
Exactly.
That is both incredibly reassuring for the stability of the global market and a pretty stark warning for anyone trying to cut corners in their backyard treehouse.
Absolutely.
Well, if you're sitting there wondering how your own company's blueprint measures up, now is definitely the time to check the foundations before the 2026 rules lock into place. Thanks for diving into this with us. Keep questioning the structures around you, make sure your blueprints are sound, and we will see you next time.